Welcome to Taking Stock for the week ending 3rd of November 2023, where myself, Tim Lincoln, and our head of Stock Doctor Research, Trinh, streamed you all things share market. I hope you're all well, and I know you're well, Kien, but the market certainly has had a strong bounce to start November on the back of October, where things were a little bit tough.
Yeah, it has, Tim. I mean, yeah, as you mentioned, October has been a big month for equities, down by quite a lot. And no doubt equity markets have had a short-term rally, but let's hope it's a short-term one, Tim.
Yeah, well, I don't know if we want to hope that it's short term, but we believe that, there's a high probability that this is perhaps just a bear market rally at the moment, because there's so much macro or geopolitical influences going on out there. And as you say, we believe interest rates are going to remain high for longer, and the lag effect of that will bite companies, and the ramifications of that could be quite severe. So we believe volatility is going to last a bit longer, but more on that in a moment. And let's swing back to a bit of a summary on October, Kian. But great to see you as always. And October is really famous for things like, Black Tuesday crash that triggered the Great Depression in 1929. And of course, 1987 Black Monday, where we saw the market crash significantly there also. And not to mention the volatility that occurred during the global financial crisis of 2008. And this year, October lived up to its name, Kian, with the All Ordinaries Index falling by, around 4% over the month, and the small caps declining by 5.5%. And in the US, they suffered a volatility too. They weren't down quite as much as the Aussie market, though, down 2.2%. And that was on the back of, a better than probably expected quarterly reporting season over there. And now let's just quickly shift our focus then, Kien, to what actually is causing the current volatility.
Yeah, good point, Tim. The main driver of the volatility has been the potential contagion of the conflict across the Middle East. We've been talking about that over the last couple of weeks, and this has led, you can see that with the chart on screen, this has led to a 7% rally in gold, known as a safe haven in times of geopolitical uncertainty. In addition, you have this rise in long-term bond yields, which implies that interest rates will remain higher for longer. And this has continued to put pressure on growth stocks like those in tech and healthcare, which has weighed on the performance of our star growth stocks in recent weeks. And this theme will likely continue, with the RBA expected to raise the cash rate on Melbourne Cup Day next week.
Mm-hmm. Yeah, very interesting. We wait with bated breath for Tuesday's announcement, Kian. Let's see what happens there. And with the ever-changing landscape of interest rates and geopolitical risks at the moment, and I might just add quickly, Kian, that our hearts go out to those who might be exposed to what's going on in the Middle East at the moment, especially obviously in Israel and Gaza. So if you're touched by events there, then our thoughts are certainly with you and your loved ones. And Kian, it's really important that we separate the facts from the noise, isn't it? Always, but it's in particular right now, with rising interest rates continuing to put significant pressure on businesses with little cash flow and really high debt levels. Really challenging for those businesses right now. In fact, according to ASIC, the number of insolvencies for the financial year to date has risen by over 20% thus far, which is quite alarming.
Yeah, those figures are alarming, Tim. You can see that on screen. And last month, the team recorded a further 2 corporate bankruptcies across the ASX. One was mobile satellite investment business Fulcrum Equity, FUL's the code there. And the other one, seafood wholesaler and exporter Catalano Seafood, CSF. Both businesses have been in distressed financial health for some time, and with a lack of cash flows, they've had to consistently raise equity to survive. And those who've participated in those equity raisings have now lost all their money.
Yeah, big welcome to all of our new members who have come on board, over the recent months, Kian. And a great little learning exercise. And you've just highlighted a couple of great case studies for our new members to go into and check those companies out and just see how easy it is to avoid these high-risk companies when it comes to selecting stocks and managing your portfolios, because they are at risk in this high interest rate environment of corporate failure. The probability of that is ever increasing, and you can reference those numbers we looked at on the earlier table to see that that there is that growing trend of corporate insolvency. So ideally avoided when constructing portfolios. And it's really important, isn't Kien, to focus on risk management during this phase of the economic cycle. And at the stock level, investors need to ensure that they're investing in high quality businesses that can not only survive but prosper in the current environment. That's the strength of their underlying financials will get them through. And obviously really good, strong leadership at the same time. And at the portfolio level, ensure you invest according to your stage of life and risk tolerance. So really construct your portfolios relative to, you know, where you are in life, whether you be still seeking growth and capital appreciation or needing that income to fund your lifestyle. And of course, your risk tolerance. Are you sensitive to share price volatility, or are you more tolerant? And that will allow you to have embrace volatility if you're risk tolerant, or maybe consider some of our exit indicators like SD30 TSR if you have lower tolerances to volatility. And you can allocate some of your funds if you're wanting to adopt a defensive mindset at the moment to cash. You know, maybe in these uncertain times, increase your cash holdings. We increased ours in February to around 30%, or even use ETFs as we've done using BBOS, which is a bear ETF, to hedge our portfolio against volatility and actually gain on any volatility. Our portfolios will hold up, neutralizing our portfolio in any volatility, as proved to be really beneficial through the month of October. And this approach has helped enormously our growth fund here in Australia and obviously in the US, and members can do the same by having a look at those BBOS. And we had really strong months, you know, outperforming the market both here and in the US significantly by adopting that strategy. However, it's turned a little bit against us early in November, Kien, but we remain true to that narrative that we believe interest rates will remain higher for longer, and that lag effect of a high interest rate environment could really hit the economy hard in the coming months. Turning our attention, Kien, now to a few star stock highlights. And this week, lithium producer IGO released their first quarter 2024 update and reaffirmed its 2024 production guidance. But the share price fell by 9% on the day, Kien. So, and what was really behind that quite significant fall?
Yes, Tim, lithium stocks has been volatile quite lately. Yeah. IGO's core asset is a minority interest in Greenbushes lithium mine, and that's the world's largest lithium producing asset. However, there were some concerning comments around lithium demand in general, which suggests that the majority Chinese owner of Greenbushes could scale back financial year 24 production. Hence, the market doesn't seem to believe that its financial year 24 guidance can be achieved. And as a result, we've also noticed the further negative earnings revisions, which implies that its return on invested capital will fall significantly this year, meaning that the stock may fail our growth criteria at the interim report in February.
I'm sure you're all over that and really analysing the stock very, very deeply. And I also noticed, Kien, that IGO has breached SD30 TSR. So trend-sensitive investors, those that are sensitive to volatility, should be out of the stock by now if they're managing their portfolios using that particular indicator, which is basically 30% stop loss and re-entry strategy. For those who believe that lithium prices will remain supported over the long term and rebound off these current lows, could view the stock as an opportunity, especially with it being substantially oversold. So therefore, yeah, they're trading at a really deep discount now to their fair value under Golden Rule 4.
Yeah, that's right, Tim. And our analyst, Daniel Ortiz, he believes IGO remains a high-quality operator, with the Greenbushes mine being the largest and also the lowest cost lithium asset in Australia. But keep in mind that the valuation and earnings forecast on the stock is highly dependent on changes to the lithium price, which can change quite quickly over time.
Yeah, and another company that announced its quarterly result was Dan Murphy owner, and they also own gaming venues, and Endeavour Group, Kien. And their performance over the period came in below consensus expectations, but the share price reaction was muted. Kien, what are your thoughts on the stock at the moment? And is its dividend yield of 6%, being a star income stock as well as a star growth stock, sustainable?
Yeah, there's been a lot of news on this stock in the media, Tim, and the reaction was quite muted because the share price decline in recent months suggests that the market may have been factoring some of these risks already. From our point of view, though, although we believe there is value at these prices, the stock continues to be weighed down by uncertainty, and that's with regards to the board and management and the impact of gaming restrictions in Victoria. The stock will need a catalyst for share price re-rating, and this could come if stronger cash flows are realised at their half-year result. For now, we'll wait patiently because cash flows remain resilient and defensive. Free cash flow is expected to improve this year, as you can see under Stock Doctor, and this should provide support for its 6% dividend yield. Now, looking ahead in the corporate calendar, the bank reporting season will begin. We've already got Macquarie Bank reporting their numbers this week, and next week we've got National Australia Bank expected to report their annual results. In addition, we have the AGM season continuing with Allcam, Jumbo Interactive, and NIB expected to provide their updates.
And now to Under the Microscope, Kien, and we've got a great case study this week because it's a long-term star growth stock, and but it's been really under a lot of pressure lately in regard to its share price, and that's star growth stock Resmed. And they released their first quarter 2024 update recently, Kien. And from what I can see, performance over the period was quite solid, driven by strong demand for respiratory masks, both here in Australia, the US, and for that matter, the rest of the world. So they're a global entity with really strong sales going on. But Kien, can you remind our members why its share price has been under such immense pressure over recent months?
Yeah, historically, Resmed is quite a defensive stock, but it's lost a third of its market capitalization in less than 3 months. And that's due to concerns that weight loss drug, glucagon-like peptide, GLP-1, how that stock manages obesity, and that could reduce the demand for Resmed's obstructive sleep apnea, OSA machines, known as CPAP, Tim.
Yeah, okay, thanks for that, Kien. And I noticed that our covering analyst, our senior analyst, Jason Yin, participated in a conference call with management post that first quarter 2024 update, Kien. Did the executive team provide any further insights into these concerns?
Yeah, our research team is closely monitoring these kind of events, Tim, and management is actively tracking GLP-1 patients who are also CPAP users as well. And they are currently not seeing reduced participation in mass resupply programs, which is positive. And over the long term, though, they did anticipate the use of GLP-1, and that's that weight obesity drug, that might lower the prevalence of obstructive sleep apnea by about 15% by around 2028. So they've done some modeling on this. And however, this will most likely be offset, though, by increasing CPAP penetration, which currently stands at 12% of the market. So Resmed continues to win market share, which is positive.
Yeah, it's all stacking up positively, isn't it, for relative to its current share price position? So what you've just shared with our members, Ken, is really interesting. And looking at the company's forecast numbers under Golden Rule 3, consensus remains really bullish, with earnings growth anticipated to be above 20%, while return on equity is forecast to still be 24%. Really strong numbers. And despite investor concerns, I noticed that earnings revisions are up 8% over the last 3 months. Does this mean that the recent share price slump could represent a wonderful buying opportunity?
Yeah, incredible, Tim. You can see earnings trend continue to move higher, whereas share prices have fallen. And the the strong forecast numbers are the result of lower expected costs. You've also got a moderation in research and development and currency movements as well, noting that Resmed reports in US dollars. From a fundamental perspective, we do believe that the emergence of this weight loss drug will not significantly impact the demand for CPAP machines that Resmed rolls out. So Resmed retains a very strong competitive advantage, Tim, and as such, we view the discount to fair value as an opportunity for those long-term investors.
Yeah, with management providing, really strong guidance in regard to a long runway for further global growth for the business, this whole thing doesn't make any sense to me. No sense at all. And so I regard it as great opportunity, but there may be something I'm missing. But those investors that are members of Stock Doctor, who are trend sensitive and are using that SD30 TSR stop loss indicator as part of their portfolio management and stock management strategies, it's triggered, and therefore they'd be on the sidelines. But I'm seeing this as a great opportunity. And now the question of the week, Kien. And this week we're focusing on a question that we had in Lincoln Live, actually. And a member provided us with a chart similar to the one that's on the screen that identifies the economic cycle chart that shows where things should be relative to where the economy is in relative to cycles. And the question posed, which sectors, Kien, should do well in the current market cycle?
Yeah, very interesting chart, Tim. And it shows the stock market cycle in blue overlaid with the economic cycle in yellow. Notice how the market cycle leads the economic cycle. And this is because markets tend to look forward while economic data highlights what has happened in the past. And looking at the chart, it seems that we are past the peak of both cycles and we are heading towards a period of economic contraction. So in theory, it would make sense to stick to defensive sectors such as healthcare, utilities, and consumer staples. But in reality, Tim, markets are more unpredictable. And using this analogy to assess markets can be quite precarious. For example, currently healthcare, consumer staples, and utilities have been underperforming the market in recent months. Meanwhile, energy and materials have remained more resilient.
Yeah, it's really interesting, isn't it, Kien, as you said? And, theoretically and conceptually, economic cycle charts, really, really interesting, no doubt about it. But they're never linear. So you can't absolutely rely on them. You've just ideally got to just roll with the economies, have portfolios of high quality stocks relative to your objectives, and manage those portfolios based on your tolerances to volatility and stage of life, as we touched on before. So that's how we sort of see them. But the timing the markets is really dangerous also, isn't it? We know that. We've just got to be there for the long term, because there's many factors always that drive either the bulls or the bears in equity markets. And this is why we block out the noise and focus on the facts and fundamentals of companies, as opposed to worrying too much about the massive macro information coming through, and also from that sector level. So we're really bottom up stock pickers, and our quantitative approach allows us to invest in the most profitable companies, irrespective of the market environment or that sector exposure. And we manage risks by assessing the financial health, and your analyst team, Kien, they scour the businesses to really assess the active risks and therefore their appropriateness to hold a star stock rating next to their names.
Yeah, that's right, Tim. I mean, and this is a good example as well. Even though the retail sector appears to be quite vulnerable to the interest rate environment, we don't exclude this sector entirely, but rather we focus our exposure towards those high quality businesses like Wesfarmers, Tim, Super Retail, and even GUD Holdings. And these stocks have continued to perform resiliently.
Yeah, and some great names there, Kien, and great names amongst all of our star stocks. And even if members run their filters, they'll find some really nice stocks that are on the cusp of being star stocks, either growth, borderline, or income, and worthy investments. So they're great names, but they won't all perform well at the same time. They won't all go up together. If we can shoot for that 50 to 60%. Of positive performers as opposed to negative, then over the long term, our portfolios do well. So even though they're great names, don't expect them to all shoot up at the same time. That's not reality. So have proper expectations in place. And just a reminder, Kien, that we've got Lincoln Live on Monday morning. So we're ever popular. It continues to grow. So tune in if you can. On Monday morning at 10:30 Eastern summertime, and also Melbourne Cup on Tuesday. So our office is actually closed on Tuesday, but all of the Stock Doctor data will continue to flow through to you, and we'll open again on Wednesday morning. And Kien, just in summary, today we really focused on the importance of avoid market timing. Don't be spooked by the volatility at the moment. You see these bear market rallies occur that we believe is bear market rally, probably more volatility come. Just stay focused, block out the noise, and focus on the facts and fundamentals of businesses, and continue to construct your portfolio of those high quality businesses, and embrace for what might be ahead. And the volatility across our high quality stocks like Resmed doesn't make any sense. I'll reinforce that one, and can create exceptional opportunities for long-term investors if you are that opportunistic investor. So great sitting down with you again, Kien. Always terrific, mate. Thanks for your passion and for all of your team's support to our members.
Likewise, Tim, and to remember, risk management is so important in this environment.
Yep. Yeah, absolutely. Very wise words indeed. So take care, everyone. Remember, our hearts go out to you all, those that are touched by the incidents that are happening in the Middle East at the moment. Take care and have a happy, healthy, and prosperous week.